Welcome to episode 7 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and deal-by-deal private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's interview was with Matt Bodnar. Guys, let's tee up the conversation. Nicholas, what struck you from our conversation?
Matt is an incredibly charismatic and well-read sponsor. He's been doing this for a long time, being in the small business space, so I couldn't have enjoyed the conversation more. And one thing that he spends quite a bit of time on in our conversation is discussing the importance of deal flow and his deliberate strategic approach to this as a key lever for value creation. And so where a lot of sponsors view deal sourcing as kind of this necessary evil that they do before they get to the value creation step of operating and growing a company, I think Matt, correctly so, views deal sourcing as the area where he probably can create the most value of anywhere. And so he views time he can spend in his portfolio companies as a direct trade-off versus time he can spend on finding the next deal that is valued at 4 to 5x. We also spent time walking through the economics of why a value investor, and he says he's inspired by Warren Buffett. You have to be in the 4 to 5x range in order to kind of get the terms you want. And so he goes into depth there. But anyway, I mean, the guy did a TED talk on deal sourcing. There's a 45-minute video on YouTube where he presents 23 ways to do deal flow sourcing. And so he goes into depth there about how he does it and why it's so important to have an edge in deal sourcing. And where a lot of sponsors will say, oh, we are just so well known, or we have such a good reputation, or people know us and we have warm intros to good deals. You know, they take a little bit more of a reactive and laissez-faire approach to deal sourcing. Matt very much takes the view of the more time I invest in this, the more volume of great businesses I will find. And it's a rational, logical way to approach the whole profession of being an independent sponsor.
I'll just echo what you said about his charisma. He's does a lot of online content, which will be no surprise because you'll quickly see that he's a really fun, dynamic speaker. So really talented, and it just makes the episode just carry right along. Really a fun one. What do you think, Max?
I couldn't agree more about the deal sourcing. It was like a master class in deal sourcing. I think new and experienced independent sponsors are going to get a lot out of listening to Matt talk about his method for deal sourcing and how very personal it is to him and how much time he spends on it. So that was outstanding. He is a value investor, or has become more of a value investor. I thought his transition from investing in SaaS to more kind of old businesses now was interesting and very smart. He's buying businesses, as Nicholas said, kind of 5x and under EBITDA. And it's interesting because I am seeing a little bit of valuation creep on deals lately. I've seen some deals come through that look otherwise good, but are maybe a turn or a turn and a half overvalued. And it makes a huge difference in how that deal might perform and what the returns might be for the investors. So it was interesting that Matt said specifically the best deals from a valuation standpoint tend to be, and from just an execution standpoint, the best deals tend to be larger with a solvable complexity. So there's a little bit of hair on the deal potentially, but it's solvable. So the sponsor's skill set needs to match what that problem is and be able to solve it post-closing. But that's going to give him the ability to buy the deal at maybe a slightly lower valuation, execute on that strategy, solve that problem, and then deliver a really strong return. I thought that was just an outstanding outlook on value investing.
Max, you mentioned there that we're seeing recently valuations creeping up, and you're saying 1 to 1.5 times over. Is this assets that are valued above market, or are they valued at market? And what we're seeing is just that delta we've often seen in lower middle market, where they're able to buy assets cheap, that arbitrage or delta has gone away.
I mean, it's a great question, isn't it? I think the space has become more competitive, undoubtedly, between more sponsors, even search funds that tend to push up higher into slightly bigger assets. They're buying companies with a little bit more EBITDA nowadays. So there's more competition. It's hard to say, is the arbitrage still available? I think it probably is. I think it's probably harder to come by. It'd be interesting to see just the number of deals overall that are flowing through the ecosystem. Deals that either close or don't. Is deal flow up or is deal flow down? I'm not sure what the answer is, but I think it's possible that some of that arbitrage is not there anymore. And perhaps some of these deals are just slightly overvalued. But I think there's still good deals out there. And if you follow that advice of Matt, the best deals are going to have a little bit of hair on them. So there's going to be some deal component or some deal characteristic that's going to cause some investors to balk. And it's going to present an opportunity for the right investor.
My takeaway that I'll share is how Matt is such a good example of the increasing uselessness of labels in entrepreneurship through acquisition. Because Matt is we kind of see him as an independent sponsor, but he's kind of also a searcher. He did an SBA. He's done SBA stuff. He's also long-term hold. He's got a portfolio, and kind of portfolio plus long-term hold is sort of holdco. He aspires to be like Berkshire Hathaway, so he doesn't slot neatly into any of these labels, and he's just the latest example of all the kind of entrepreneurs that we see and that I see over in Acquiring Minds, who are buying businesses as their path to entrepreneurship, and the models and ways you do that continue to kind of proliferate. So he's just a great example of that.
One thing I'll just add to this whole conversation, what we're seeing a theme develop with these episodes. And I think that theme is there are multiple ways to be an independent sponsor, and many of them have their own unique niche carved out. And I think we're seeing a slightly different niche so far with each sponsor.
Yeah. Yeah.
I love that.
Well, with that, guys, let's turn our attention now to Matt Bodnar, episode 7 of the Minds Capital podcast. Enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Today's guest is Matt Bodnar, an independent sponsor based in Nashville. Formerly a trader at Goldman, he made the jump into entrepreneurship back in 2012 through his acquisition of $1 million IT services business. It was here that he transitioned from being an operator to his now incarnation as an independent sponsor. Today, he's got 4 active portcos and several exits under his belt. He's also a prolific content marketer, near and dear to our heart here at Minds Capital, and even had a podcast in a psychology related podcast. You'll have to tell us a little bit about that. Matt views himself as a value investor, an acolyte of Mr. Buffett, and claims he could do a TED Talk on deal flow. So we're gonna try to extract some of those TED Talk nuggets here in a few minutes. Matt, welcome to Meeting of the Minds.
Well, Will, thank you so much for having me on the show. I'm really excited to be here, and would be happy to unpack deal flow, Buffett, Munger, how I got deep into the rabbit hole of psychology or deal making, whatever floats your boat.
I think the deal making is what at least want to start with. So tell us how you transitioned from your W-2 at Goldman and into buying and running a small business.
Yeah, so it wasn't necessarily a grand master plan. When I went and worked at Goldman out of school for a few years up in New York, I thought, there's a couple different potential trajectories I would take. One of them was going to the quote unquote buy side, but I probably envisioned that being much more going to an actual large PE firm instead of being sort of an independent sponsor doing a deal on my own. But I'm from Nashville originally. And when I came back to Nashville in 2011, my dad and my brother in the restaurant business. And so I came back and was helping them with some of the stuff they were doing in the restaurant world, and stumbled across basically a vendor of ours that we had a relationship with that was selling point of sale terminals, Aloha point of sale specifically. And they were doing about $1 million a year of revenue. And was run by a classic, if you've ever read E-Myth by Michael Gerber, sort of a classic technician founder who really didn't have or bring a lot of the business skill sets. And so the company had a huge hundreds of thousands of dollars of receivables that had aged 6+ months, basically never really made any efforts at collection, and they were scraping by, barely able to make payroll. And they were doing about $1 million of top line revenue. So not a huge business, P&L wise, effectively breaking even. And I didn't really know what I was doing. And I sort of negotiated a relationship to say, hey, I think I can come in and help fix this thing. And I see some real opportunity here. I like technology. I'd always been a video gamer, so the tech world was sort of interesting to me broadly. And I said, hey, let's figure something out. And we worked out a deal basically to buy a portion of the business effectively at almost no valuation for multi-year sort of seller-financed buy-in. Did that, ended up running the business for a number of years. We did a few add-on acquisitions, eventually actually divested the point of sale business entirely. And when we did that, basically the partner at the time who founded the business was the sort of technical founder. He really liked that business and the sort of elements of it. I didn't think it was a very compelling business and didn't have a great future. And it was kind of had a bunch of headaches, which I'm happy to unpack if we want to. But we ultimately divested that and gave him 100% ownership of that business unit in exchange for his ownership of the rest of the business. And we sort of trued the rest up for whatever the economic difference was, with a note basically. And so ended up becoming at that time an IT services business with a couple little inklings in the software space. We eventually acquired one or two relevant vertical SaaS companies that were kind of related to some of the customer base we were serving, which was still mostly at the time in the restaurant segment. And then eventually we've kind of grown that business. The MSP business is still sort of a standalone profitable operating company. And then we also have really grown a SaaS company out of that business that we've actually raised some institutional capital into. So that was sort of my first portco. But I fired myself in kind of late 2016, early 2017, brought in a more professional technology executive and said, I did a lot of soul searching around that, but basically realized, hey, I much prefer the seat of being an investor than I do being an operator day to day in the trenches. And so I started hunting around for more acquisition opportunities and have kind of stumbled my way into having a little bit of a portfolio of operating companies today. And that's what I'm up to.
Awesome. Nat, so that was a 5-year journey as operator, basically leading this business.
That's
and it
right.
sounds like you led it to success out of effectively break even or worse, made big strategic decisions, took it in different directions, divested the business of assets that didn't make sense. So it sounds like you were pretty effective as CEO, but you decided that being an operator you didn't like, and you thought that being an investor is what you would prefer to do, even though you actually hadn't really been an investor yet, a capital allocator yet. I guess elaborate a little bit on that decision.
I read, I'm sure you guys are familiar with the book, The Outsiders, early in my tenure, because I think it came out around that sort of 2012 time. I don't know exactly when it came out, but somewhere around there. And they talk a lot about in that book about sort of CEOs being capital allocators and having a capital allocator mindset. And that's how I always thought about the business. I thought of it as sort of a different divisions, component parts. We're sort of trying to optimize that whole puzzle and really efficiently allocate the income streams. And in some ways, even then, that's when I started to become super interested in Warren Buffett. It kind of dawned on me. I was like, hey, if I'm interested in this whole sort of investing world, I should study arguably the greatest investor of all time. So I just started voraciously consuming everything written about Buffett. And if you do that, then you obviously come across Charlie Munger. And then I became even more interested in Munger and started really consuming a lot of his content, a lot of his resources, and really studying all the stuff he talks about, which is how I got the psychology bug, because he's big on the whole mental models concept and digging into psychology and underpinning human behavior, which is ultimately, I think, a really valuable set of business tools that they don't really teach anywhere. But anyway, I got all into that. But, I'd always had this vision of one day when I grow up, quote unquote, right? Whether that's have a big exit, whether that's raise a big fund, because this is really before independent sponsors was even a thing. One day when I grow up and I have insert a number here, $100 million fund or balance sheet or whatever, then I can go buy businesses, because I'd always been really interested in doing that. And I was having coffee basically with a friend of mine, and he was showing me this slide deck that this guy had put together. And in it, there was it was about a bunch of different stuff, but there was a random case study of, he didn't really call it this, but basically an independent sponsor deal. And I was like, wait a second, this guy bought this company without a fund, without really putting in a huge amount of capital. How did he do that? And I became sort of obsessed with this. And this was right around that same time frame. And I said, hey, I don't have to wait 30 years and do all these things. I can start to do this now, because all of these new economic models have started emerging with things like independent sponsorship and the SMB space and all of that stuff. And so I got really deep down that rabbit hole and said, hey, I don't have to wait a million years to do this. I can do it now. And then that's how I sort of embarked on the journey.
And Matt, I think to set more context for the rest of this conversation, let's understand what your portfolio looks like today, what your positioning is, because I feel like while we're calling you an independent sponsor, it's not the tightest fit of a label. So just give us a snapshot of what Eidolon Capital is.
Yeah. So, I mean, I view Eidolon as a holding company. It's modeled after Berkshire Hathaway's model, basically, which, again, I don't purport to be anything even 0.01% as cool or as successful or smart as Buffett and Munger. But I like their business model, and I try to sort of humbly and crudely copy what elements of it I'm capable of copying. And so the current portfolio at Eidolon, we still have that technology business. And it sort of predates the creation of Eidolon itself, but I can spiritually consider it sort of my first portfolio company. We have a business that's a distributor of pallet racking and material handling. We have a manufacturing business that manufactures portable sinks, which I know there's a little bit of crossover on. We've got a really small kind of staffing company that does light industrial staffing. And then we recently acquired a metal fabrication and manufacturing business focused really around electrical enclosures and circuit breakers and power production, which is a space that we're really keenly interested in. And so the portfolio itself now, as you can probably get a sense, skews mostly to sort of old school B2B manufacturing, old economy type businesses. And how I got there from being in the software and technology world is part of that iteration. When I scaled myself out of running FTI, which is our tech business, I set out initially to say, hey, I want to go buy a software business, because I love software. I think it's one of the best business models out there. I think that's largely undisputable. But the problem is, it's also one of the most competitive and expensive markets to buy businesses, mostly institutionally capitalized with venture investors and so forth. And so it's really hard to find bargains or value-based companies in the software world. And even if you can find them on a relative basis that are, value-oriented from an investment thesis, it's still really hard to capitalize those deals using an independent sponsor model without being just massively equity heavy, right? So if you're buying a company that's trading at 5x ARR, right, the actual amount of senior leverage you can put on that deal could be de minimis. It could be, you get a turn or two of EBITDA, which most SaaS companies don't even have EBITDA because they operate at burn rates or ongoing operating losses. But somehow, if it's a profitable business, 10 times revenue, let's say you're doing 10 million of revenue and $1 million of EBITDA, right? It's $100 million enterprise value. And so you get 5 turns of leverage, which is obviously ambitious. You're 5% of your purchase price, right? And maybe 10x ARR is too absurd of a target, but even if it's 50, 10% of your purchase price is debt and the other 90% is equity. That's really hard to raise. And I just over time iterated towards businesses that I could purchase at what I thought were attractive entry multiples, typically looking for stuff at 5 times or less, and could be capitalized well using a traditional LBO model. And by the time you bake in a little bit of structure or rolled equity or seller notes, et cetera, the equity lift and the capital raise becomes easier. And then that also generally, so again, it's just the function of leverage and low purchase price, can command pretty strong deal level economics potentially, because if you're buying a business for 4.5 times EBITDA and the seller's carrying 20% of the purchase price and you're financing 2.5 turns of senior leverage, the equity check just doesn't have to be that large. And so that's how I landed eventually in sort of the B2B industrials world. Is it just a space where I couldn't get the value investor bug out of my head of, hey, I really don't want to go buy something for 7 or 8 times EBITDA. I want to buy something for 4 or 5 times EBITDA. And so I need to hunt around for places that's possible.
And how do you think about, do you hold these businesses indefinitely, or are you on a more traditional, from private equity perspective, exit in 5 to 8 years?
Preference is to hold them. Again, that doesn't always materialize. That's not the thesis in every case, in many instances. But we try to have a very long-term orientation. That comes again from just Buffett and Munger and their approach. My view, my sort of perfect future is I want to have a portfolio of businesses that eventually are largely delevered over time, that just generate torrents of cash flow that we can then make decisions about redeploying into things, right? Whether those are new opportunities, investments, distributions, whatever it might be. I just want to build a huge cash flow stream that I can be redirecting into new opportunities, new ideas, et cetera. And so that's kind of the thesis, is really more of a buy and hold, build cash flow. I also feel like you generally make better decisions for the business if you have a little bit more of a long-term orientation. And it sometimes also selects for different founders, which are looking for a slightly different thing, to find somebody who is more long-term oriented and lets us paint a picture and build a relationship with a seller that's more about how we're going to take care of the business and shepherd it over the long term, and not we're going to juice it, slash a bunch of costs, and resell it again in 3 years as quickly as we possibly can.
Let me take you back a moment there to the contrast that you made between software companies and high valuations, and B2B industrials as an example of where you can fish and get 45 times EBITDA valuations. So you're saying a low valuation, and in that case, you can get away with raising only 1 turn of equity. And that is not only an easier job than raising 3 or 5 or 45 times equity, as you stipulated there, but it also feeds into the economics that you can get as a sponsor. And
that's exactly right.
That maybe the standard sponsor rates can be improved upon if you have that approach. Can you flesh that out a little bit more?
Yeah, absolutely. I think that's generally my thesis. And I mean, I'll use a rough example, and maybe I need to bust out a spreadsheet here to make sure my math is all tying out. But if, let's say we have a business that's doing 2 million of EBITDA, right? And we're going to buy it just plain vanilla. We'll buy it for 5 times EBITDA, right? Which I think would be on the higher end of this sort of value-oriented approach. So if we're buying it for 5 times, we would probably ask the seller to carry a turn, right? Or maybe even a little more than a turn. So on a $10 million enterprise value, we'll ask the seller to carry 2, maybe 2.5, right? And so then if we can get, let's say, 3 turns of senior leverage, right? And by say 2.5 million, not 2.5 turns of EBITDA. If we get 3 turns of senior leverage, that's 6 million of senior debt. We've got the seller carrying 2.5. That's $1.5 million equity raise potentially. And that's less than 1 times EBITDA, right? And so depending on what your leverage looks like, I'd need to bust out my payments calculator here to get a sense of what debt service might look like on a $6 million loan. But you could generally command, and again, some of this is going to depend on what the capital reinvestment of the business and other things need to be, but you're generally generating like a reasonably high return on equity. And so if you can do that, that gives you the ability to ask for better economics, right? If you can still pencil, I mean, you guys probably know better than I do, but I think rough market expectations for a private investor in an SMB or an independent sponsor deal would be, aside from structure, i.e. like what the pref is and what the promote is, aside from structure, the return expectations I think are generally in the maybe 30 to 40% IRR and like 3 to 4x, multiple on invested capital. And again, there's some noise to either direction there, but I think if you're penciling those returns, they can be pretty strong. I think you can achieve that if you're buying a business that's at 5 times. You buy a business at 4 times, you get the seller to carry a turn, right? So if we're buying that business for $8 million, the seller carries $2 million. We need 6. We get 2.5 turns of senior leverage, right? That at that point we're raising half a turn of equity, raising $1 million of equity, and EBITDA is $2 million. That starts to get really interesting in terms of our ability to generate and show really strong returns on capital, really strong IRRs. Here, I'm going to run, if I can do this in real time, I'll just run a rough debt service calculation to give you a sense of how much free cash flow you would have remaining after debt service on, 2.5 or 3 turns of senior leverage on a deal like that. But that's the concept, if it makes sense.
That makes sense.
Yeah,
and I think buying cheap as a way to create value, it's not necessarily a new trick, but
definitely
does
not.
it jive with buying cheap and buying undervalued are two different things?
That is
right?
Extremely true.
And so even Buffett will say it's better to buy great businesses at fair prices than fair businesses at great prices, right?
That's exactly right. Yeah. And that's ironically a lesson he learned from Munger. And Munger constantly was harping on him because he used to buy cigar butts back in the day, right? And then started moving more towards better enterprises at fair valuations. And I want to unpack that a little more. I just ran the math really quickly just to give you guys a sense. So in the scenario I shared a minute ago, let's say we're paying 5 times for this $2 million EBITDA business, right? The seller carries $2 million, right? We raise $2 million and we get a senior loan for $6 million. In that scenario, our debt service is at $6 million for a 10-year term, or sorry, a 10-year AM at 10%. And again, maybe an SBIC is going to give you some flexible IO, whatever. Maybe if you're doing SBA pari passu, you're probably going to have similar terms to that. Your debt service is $950,000 a year, right? So let's just call it $1 million, round numbers. So if you have 2 of EBITDA, $1 million goes to debt service, and you have $2 million of equity. If you're distributing that, again, maybe you have some holdbacks, capex, whatever. That's a 50%, return on capital if you're just making distributions after debt service and don't grow the business at all, and don't reinvest in it. Which again, maybe you're carving out some dollars for reinvestment. But even if you carve half of that out and you're only distributing $500,000 a year, that's still 25% returns on invested capital in terms of cash on cash, because of the low purchase multiple and the leverage structure.
The math makes sense, and that's fantastic that you walk us through that. Very, very illustrative. Now, how does this jive with the evolution of the independent sponsor space? Because in the space overall, it's growing phenomenally, and we're seeing bigger deals, right? The sponsors who were doing 2 and 3 million EBITDA deals 6 or 7 years ago are doing 10 or 15 million EBITDA deals today. And with high or bigger companies, you pay higher valuations.
Yep.
Right. So where they paid 4 or 5 times 6 or 7 years ago, they are now paying 7 or 8 times because these businesses are bigger. So does this in any way compromise the model, or is there a limit or cap to where the model can go? On top of 2 to 4 times leverage and rollover, how much equity can a deal underwrite, or what has to be true in order to underwrite 4 or 5 times equity if you're paying 8x on something?
Yeah, and I mean, I think there's a sweet spot here, and you're right that there's sort of 2 forces at play. One is it's gotten somewhat more competitive in terms of more sponsors, more buyers entering the market, and so people are chasing deals that are smaller and smaller. But I still think there's a pretty compelling sweet spot of stuff that's like the space I like to play is sort of 2 to 5 million of EBITDA, because it's you don't get as much PE competition, though. Again, they've come down. The SMB buyers are typically looking at stuff that's a little bit smaller than that. And so it's kind of a no man's land, or has been, where you can still get decently sized deals for somewhat reasonable prices. Now, again, I spend a lot of time turning over rocks and trawling around for opportunities to find those deals. But I think that's been historically the spot where I've seen that dynamic still be achievable. In a perfect competition market, eventually that starts getting eroded, right? And pricing comes up and it gets harder to find attractive undervalued deals and all of this stuff. I think you're certainly right. The bigger you go, like once you're getting mid to high single digit EBITDA and beyond, multiples expand meaningfully. And I think the capital base also gets substantially more institutional, right? So if we come back to that sort of case study deal we looked at a second ago, you're raising on the high end $2 million of equity. That's, I would argue, and some people may disagree with me, I think that's a very achievable raise from like friends and family or country club or pass the hat or whatever. Even if you're raising it $100K at a time, that's only 20 investors, right? I mean, that's just a bunch of phone calls, smiling and dialing, maybe bringing in a capital advisor or a bank to help you raise some of those dollars. But like $2 million is an achievable raise from high net worth accredited investors in many cases. And again, maybe not for everybody, but I think generally that's a surmountable obstacle. If you're raising 50 million of equity, you're only going to institutional sources, right? And so once you cross over a certain EBITDA threshold, and once you cross into these more institutional deals, I think you're going to have to, you're only really interacting with institutional equity, and the returns, you get much worse deal economics, worse in quotes, you get much worse deal economics, but the deals are so much larger that maybe sometimes it ends up balancing or even still being more economics than you would get owning a large chunk of a smaller deal. Now, the factor that's been offsetting that, interestingly, over the last few years, and I think this has really more recently emerged, is this sort of self-funded searcher economic model in the SMB space is fascinating, because they're using this sort of preferred return with an equity step up, and they're using SBA in a lot of cases. So these are highly levered deals, and in many cases, the sponsor is getting like 60, 70, 80% of the common with this step up structure. And so that's pushing sponsor economics higher. And so when I saw folks doing that, when I originally embarked on this journey, I was thinking about it more from just, hey, 8 to 12 pref to, 20% promote, maybe 30% with some advanced hurdles or whatever. But as you start to look at what people are doing in the SMB and the self-funded searcher space, they're commanding way different economics, and they're still generating that sort of 30 to 40% IRR and 3 to 5x multiple on invested capital, because they're using the SBA program or the SBA pari passu program to generate really high leverage and really low equity needs, which you can get to pretty compelling returns on capital pretty quickly as a result of. So that's kind of pushing sponsor economics up. And then you have, the bigger the deal gets, though, ultimately with a large equity need, you're going to have to go to institutional capital, and they're going to dictate the terms, and they're going to be much more market terms.
Funny to hear your observation, Matt, that self-funded searcher economics are pulling up independent sponsor economics, because we, and Nicholas in particular, has predicted that the dynamic would go in the other direction, that self-funded search terms would come back down to earth, closer to the 20 and 30% carry that is kind of standard across independent sponsor land and private equity. So interesting that it's going in the other direction. Maybe they'll meet in the middle.
That'd be great. I mean, I think it's good for sponsors, right? And a lot of it, it's like a multivariate analysis of a couple different things, right? So it's, to some extent, it's just leverage that you have as a sponsor, it's network and track record that you have as a sponsor, it's quality of the transaction, and it's, returns on the transaction. And then it's like, how much capital do you need to raise? Like, I think all of those are variables that could go into that equation, right? And when I started seeing how some of the stuff was pricing in the SMB searcher world, I started thinking to myself, like, this is wild. Like, how can I copy some of these economics and paste them into bigger transactions? And at a certain point, Nicholas is right. It breaks because you need too much capital. But if you can still generate strong returns, and you can have a transaction that pencils well, and you control, and you have access to a pool of capital that likes the return profile, I think you can still raise at pretty compelling economic structures, if that makes sense, even as an independent sponsor, quote unquote, but borrowing from the SMB searcher model.
The way I've approached it in the past is to effectively reverse engineer my model, right? And I think a lot of sponsors do that. They know they have to generate 30% plus 35% IRR for their investors.
Yep.
Ideally, that should be a lump sum after 5 years, and not front loaded too much with dividends, because those are, the early years there's more uncertainty around what the distributable cash you have. But granted that you have that 5-year lump sum, you reverse engineer, your growth rate can be more or less intact with what it's been in the past. Your margin can be more or less intact with what it's been in the past. You can maybe layer in a couple of tuck-in acquisitions. You can assume a future exit valuation based on some comps. But the biggest driver of value as you reverse engineer that, there are two things, right? It's the entry multiple and it's the GP economics. And so you're saying if the entry multiple is low enough, it enables me to offset that on the GP economics and still land at the 35% IRR.
That's a really succinct way of putting it. And I think the knife's edge that you have to balance on, and maybe it's not a knife's edge, but you hit on this a minute ago. Low entry multiple is positive for the deal economics, but you also want to make sure that it's still a good deal, right? And that's hard to do. Because you don't want to buy something, it kind of goes back to the old Buffett Munger lesson from Cigar Butts. It's like, if you're paying 3 times for a business, that's a great entry multiple. But if the business is a terrible business, then you might be overpaying, right? And so, or you're not actually going to generate the returns. And so that's really where the rubber meets the road, is trying to find businesses that are well priced and understanding the dynamics of why the pricing is compelling. And is it a solvable issue? Is it a non-solvable issue? Is it a question of market efficiency, i.e. the deal was off market or wasn't well marketed? What are the factors that are driving the low acquisition multiple? Brad Jacobs wrote a book, How to Make a Few $1 Billion, which is a great read, very M&A focused, came out, I think, last year. And he has this grid in the book that's basically like deal size and deal quality. Basically, I don't know if he calls it quality, but it's basically like bad deals that are small is like the pain pit. Don't ever go there, right? Good deals that are small are great, but like they don't move the needle a ton, but they're still nice to haves. Big deals that are great are impossible to find because they instantly get snapped up and the value gets arbed out. And his whole thing is like the real value is in the big deals that have some element of complexity, and whether you can answer the question of, is this complexity solvable in a way that I can unlock and build enterprise value? Or is this an endemic sort of structural challenge with a business that's unsolvable, right? And that's really where you can unlock value or not, if you can answer that question.
And so, Matt, do you apply that grid in your own acquisitions? Are you looking for some hair that you are uniquely capable of combing out?
To some extent. I mean, we're not looking for stuff that's distressed, right? We're not looking for big, massive challenges. And I've looked at some stuff in that world. I'm loosely familiar with it. It's just too much headache. I have a friend of mine. Actually, we bought one of our portfolio companies. We bought out of receivership. But it wasn't in receivership because of its financial performance. It was basically a divorce from husband and wife, very, contentious. And when we acquired the business, we bought it from, it was like a court mandated sale process. So it was really interesting. But I'd known the CRO who kind of ran that process for a number of years and looked at a few other deals that they'd worked on, and had a lot of conversations with him about, hey, what's that world like? Do you like it? Do you not like it? And he was like, it's just incredibly stressful. Always, everybody's always suing everybody. It's very, draining and emotionally difficult. And so we try to stay out of the purely distressed and try to figure out, is there some smaller nuance that we can potentially fix? And I'll give you 1 or 2 illustrations of this just to conceptualize it. So one would be, if you're looking at something like an MSP or IT services vertical, right, which is obviously a hot roll-up vertical these days. Typical buy box, and maybe this has changed a little bit since I last sort of did some homework on this, but typically people are looking for about 60% or more recurring revenue. And if you're below that threshold, you'll typically see a huge precipitous fall off of buyer interest from add-ons for PE firms or from sponsors that are looking for new platforms. And so the question is like, okay, well, what if you find a business that's like 45% recurring revenue, and instead of buying it for 6 or 7x, you buy it for 4.5x, and then you spend 18 to 24 months taking it to 60% recurring revenue, right? Then you get that multiple expansion because you fixed what made the business less desirable to buyers, right? Now, and you have to have a thesis around how you can potentially fix that. But that would be one example of like an inefficiency that maybe isn't this like insurmountable structural problem with the business that you could think about fixing to increase value and or look for to find maybe some rocks to overturn that other people aren't paying attention to.
I think another example that we just heard actually in another episode, Will, right, was someone who bought a high customer concentration business for 4x, which is troublesome in and of itself. But if you buy 5 of them,
yep,
not only do you have a 5 times larger business, but all of a sudden you don't have customer concentration any longer. So you can command a much higher.
That's another classic case study. You buy a concentrated business and then deconcentrate it with add-ons or organic. And then suddenly you see an instant sort of uptick in multiples.
Well, and one thing that comes up here and there on Acquiring Minds in Searchland is just size. So buying small, too small for private equity or a buyer platform, too small to be a platform from somebody, So you make the platform either by, taking a 500,000 SDE business to $1 million of EBITDA, or doing a kind of a mini roll up of very small businesses into something. So it's so interesting to kind of think about what everybody's looking for that nobody can find, and buying just below that, or buying in a way that you're adjacent to that, but the quality either because of size or because of concentration or because of revenue mix just doesn't hit the buy box, and then you buying it for way less and pushing it into the buy box for those buyers, and that becomes the thesis almost.
Yeah, I think that's a big piece of how we put some of those puzzle pieces together. And it's interesting, like size is something I think about a lot. And as I've matured, I think I'm still relatively early in my journey, at least in my head. But as I've matured, I've increasingly, I think any sponsor does this, ratcheted up the size of deals that I look at, right? And so I think I would much rather look at a deal that I can fix some other issue other than size, right? I think it's hard to go from 500K to $1 million from SDE to EBITDA. I think it's easier to go from like 3 million to 4 million, right? Just because you have way more infrastructure and you can pay for more resources. You have a more talented management team. You can cover your own expenses more easily, and management fee, whatever it might be. Like, I just think I like bigger businesses, but it's hard, obviously, to find.
Well, that's the thing. Where do you want to devote your resources? Because to find the bigger businesses means you're spending more time on deal flow. So none of it ain't free. You still got to go find the business, which is going to be, that's where the resources are going to go. As you've grown your size, your appetite for the size of business that you want, how has your deal flow evolved? What's the latest and greatest in the Bodnar toolkit these days?
So yeah, I mean, I've done a lot of content on deal flow, and I think I have like a 45-minute like YouTube video on 23 different deal flow strategies that goes crazy deep into some of this stuff. But like, that's the joke about the TED Talk. But like, I think about deal flow, there's two big buckets, right? So you've got sort of on-market deal flow and off-market deal flow, right? And I think most people probably gravitate when you're starting, especially towards on-market, which is fine. Like, I think I'm a fan of on-market deals, and I think sometimes they get poo-pooed, and everybody's like, "Oh, I'm only looking for proprietary stuff and doing all this work." Like, to me, if you know how to look for the right on-market things, and you know how to communicate with advisors and brokers, and you build relationships with brokers that are actually looking to get transactions done and work with reasonable sellers, you can do some great stuff on market. But I think it's a question of understanding. I try to view a relationship with a broker as like a collaboration. It's like, how can the two of us work together to find a deal that works for the seller, versus having sort of an adversarial or hostile relationship. Now, again, some brokers might just have that tone, so it's harder to do. But there's a couple elements that I really view as sourcing on-market deals that I think a lot of people miss. One of them is just, I call it hanging around the hoop, which is basically like, I keep tabs on deals that I've been interested in, and I'm always following up. And it never ceases to amaze me how often, like, a hot new listing with 4 LOIs that everybody's really excited about, 6 months later they're still on the market, and none of those really materialized. And then that, to me, that's when my ears start to perk up, and I'm like, okay, now let's talk about this deal, because it's getting more interesting, and it's less competitive, and it's not as challenging to potentially get something over the finish line. So those are the kind of deals that I think if you actually thoughtfully hang around the hoop and just keep tabs on deals you looked at 3 months ago, 6 months ago, a year ago. Like, I've got deals that I looked at in 2021 that I still ping the broker on or ping the seller on and just check. And we'll get in. I'll give you a couple ideas on off-market sourcing here in a second. But like, one of them, I think there's a lot of stuff you can do with email that a lot of people, is just like obvious stuff, but people aren't doing, which is like, I use a email automation tool, and any seller that I talk to, especially if it's off market, I have like a 4-year sequence every 6 months that just pings them like, "Hey, Will, great to chat with you. Like, how are things going? Are you potentially interested in looking at doing a deal? No worries if not, but let me know if you want to catch up sometime soon."
Which
right?
software is that?
I use a tool called Lemlist. I mean, there's probably 20 out there. I know a lot of people like stuff like Apollo. I don't use it personally just because I haven't bothered to set it up. But I just set up like a drip campaign basically that hits them every 6 months for years.
And do you apply that with business owners or also with brokers?
With both, right? So with business owners for sure. And then with brokers, typically what I'll do is if there's a deal, I'll just keep them on my, I use like a Trello board to track my deals, which is, there's probably better CRMs, but that's just what works for me. And I'll go through, be like, I have sort of a follow-up list, and every now and then I'll go, oh, hey, what's going on with this deal? And I'll just ping the broker, say, hey, what's the latest here? It's, oh, they came off the market because they had a weak 2023 and they're gearing back up and we're going to relist them. It's like, okay, well, that's an interesting deal because they've been on the market for a few years. Now the seller is going to be more motivated.
You said earlier that there were two elements that a lot of people overlook in on-market deal flow. Yep. And you mentioned hanging around the hoop as one. What was the other?
Yeah, so hanging around the hoop. The second one is just proactively, I call it upstreaming brokers. I don't know if that's a real term of art or not. It's just something I say. I think I read it somewhere. But the idea is basically you call a broker on a listing. 95% of people call a broker and they're like, hey, I'm looking at this, this metal deal that you sent. Tell me about it, blah, blah, blah. Okay, great. Well, spend 45 more seconds, say, hey, I'm typically looking for businesses that are doing 2 to 5 million of EBITDA. We're normally value-oriented buyers. We're really not looking to buy things greater than 5 times. Here's our current portfolio. Here's add-ons that we're looking for. Do you have anything else in your portfolio that might be a fit for what we're looking for? Right? And countless times I'll say that to a broker and they'll be like, oh yeah, I've got 3 or 4 other sims. Let me send them your way. Right? And a lot of times those sims aren't the new listing that I just called them on. And then those are a lot more interesting. And so to me, it's not rocket science, but it's just putting in the reps to do that. A related thing that I would also say is just mail merging or emailing. I keep a list of brokers that I like, that I actually have either transacted with or they've been really easy to deal with and thoughtful and had interesting deals. And I will send them just a little thing. It's like, hey, just a reminder, quarterly or every 6 months, here new platform sort of criteria we're looking for. Here are what we're looking for from an add-on perspective. Let me know if you have anything that fits, right? So it's like following up with the broker relationship, not just on a particular deal, but just on, hey, here's what we're doing. Just so many times people talk to a broker about one listing, it's not a fit for whatever reason, and then they just move on with their lives. That to me, you're leaving 80%, I think the fortune's in the follow-up in that case, for sure. You're leaving 80% of the value on the table when you do that.
Serious question here, actually. Have you had issues at some point ending up in the spam folder for people?
I don't know. I do have, for a lot of my outreach, I have separate email accounts. I don't use my main email account for my cold email. So you use
a separate domain for cold outreach. For follow-up, where you have built a relationship, it's probably less concerning. But I know when I've been doing proprietary,
I use my existing email account.
Yeah, I learned that the hard way for sure many years ago now. But using my normal email address, mail merge, massive cold outreach.
And when I'm talking about a mail merge, I use a tool called Yam, which is a free mail merge for Gmail, yet another mail merge. You can send 75 a day for free, right? So I'm not emailing hundreds and hundreds of people. I'm emailing a targeted list of 30 to 50 people when I'm emailing my favorite brokers, favorite in quotes, hey, here's what we're looking at. Do you have anything for me? Right.
Matt, if you're really as even that number isn't in the thousands or anything, but if you're really systematically doing that daily with brokers and sellers that you've talked to, that could result in a lot of calls, which, kudos to you. That's what you're trying to do is make, get people on the phone and hopefully shake the trees, find a deal. How much time does it end up taking per week? This whole kind of steady drumbeat of cultivating relationships, checking back in, getting back on the phone.
Yeah, I mean that's a really good question, and I think it goes through seasons, right? So if I'm hungry for a deal and I'm like, hey, I need to get a deal done, or I'm looking around it's time to do a new platform, really excited about something, it's easily 20 plus conversations a week, 20 plus booked. I try to book stuff half an hour, so it's not at least consuming my whole calendar, but easily 20 plus, 30-minute catch-up calls, intro calls with sellers, et cetera, on a weekly basis. A lot of the actual outreach is automated, more or less, right? So I try to automate most of that, and there's not a perfect correlation, but for our cold email sort of, and this I think dovetails into thinking about off-market sourcing or proprietary sourcing. For our cold email strategies, Like I'll typically just have it booked straight into like a Calendly that just books onto my calendar in certain times and windows, and has them fill out a little bit of a little survey in advance about company size and interest level and that kind of stuff. So in many cases, when I'm really pressing the gas pedal on a cold email campaign, I'll just have sellers booking into my calendar without me ever even interacting with them at all. And
wait, Matt, I have to press you on this. So you'll send out cold emails en masse, and
not math, but yes,
okay, you're not ridiculous mass,
like
but
hundreds of emails, not tens of thousands,
hundreds. And if they respond, it's a link to your calendar, and they fill out a form, and they do this.
Absolutely.
I mean, you could appreciate my surprise, because so receiving a cold email, even getting the attention of somebody is so difficult. There's so much pushback on that often from sellers. To then be confronted with a form, that they fill out, I just feel like it sounds beautifully automated and amazing to think that these sellers' conversations are just magically put on your calendar, but I'm surprised it's effective.
So
tell me more.
I'll give you a couple. I can give you some specific data points around that, and also just some reframes that were super helpful for me. So one of the biggest things I learned a while ago about, I guess, generally cold outreach / marketing as a whole. I'm not particularly an expert in marketing by any means, just as a heads up. Like I'm a novice in most of this stuff. I've borrowed from people who are better than me. But just because you don't do something doesn't mean people won't do something, right? So it's like, I would never respond to a cold email. Okay. But some percentage of the population does, right? And so, and even with the booking people into the means of the Calendly, I would say, I don't know what the actual hit rate is, but like maybe half of the meetings that book, people will just book straight off of the link in the email, and the other half will reply back again, this is of people that book, not of people that see the email, but the other half of the meetings will come from people replying back and be like, hey, Matt, I can't meet on Wednesday. Are you free Thursday morning from 9 to 11? And then I'll respond back to them and say, hey, Dave, yeah, that should work. Like, let's hop on the meeting or whatever. So Not everybody does, but I mean, I've easily booked when I have a outbound campaign running, easily 5 or 10 meetings a week of straight people booking it without me ever interacting with them at all. Like absolutely the case. And I think there's like, this is getting into some of the philosophy of this, but I'll give you some numbers from 2 prior cold email campaigns that I've run. And you guys probably know some of these benchmarks, but rough benchmarks for cold email. And this is like something I pulled maybe 6-8 months ago. These might be wrong, but roughly based on this data set that I looked at, like 24% of sales emails are open. So emails have like a 24% open rate for cold, and have about an 8.5% response rate, right? So rough industry benchmarks for cold, 24 open, 8.5 response rate. 2 different campaigns that I ran. One of them had a 91% open rate, a 32% click rate, which was like clicking to that Calendly link, basically, and a 41% reply rate, right? Another campaign, 82% open rate, 30% click rate, and like a 33%, 34% reply rate, right? And now reply doesn't necessarily equal meeting booked. But these campaigns, like why did they crush the benchmark? I think it's a couple things. And the copy itself in the emails is not terribly exciting. It's just like introducing myself. Hey, I admire what you've built with the business. Would love to connect with you and see if there's an opportunity. I think it's really, there's 2 elements in my mind that drive this, the performance way above most cold email campaigns. One, and they're interrelated. One is that it's me sending the email and not some like faceless analyst, right? Or some third party. And so it's coming from, it's a separate account I've set up, but it's still coming from me. It's not coming from like the 22-year-old junior on my team, right?
Yeah.
And the second piece of that is like, I've invested, 15 years into my like brand position, my website, all the content I put out, right? We talked about like the importance of content marketing, which you guys are obviously wizards of. When somebody Googles me or looks me up or goes to my website or sees the content I'm posting on LinkedIn or whatever, that it conveys more credibility. And I think it's generally a strong position. And so that is why I could send the same email from me with my positioning, versus somebody who has no market position. Their LinkedIn doesn't have a profile photo. There's nothing on there, that sort of stuff. And I will get a much better reply rate to the same lead with the same email. So I think it's really a function of positioning more than anything. And part of it too is just having like quality leads, making sure you're, again, this is getting outside of my skis, and from a marketing standpoint, like making sure you're scrubbing the dead emails and stuff so that you're getting better response rates to actual email inboxes. But that's been my experience with cold email, and I've run a fair amount of cold email. So I think it's a nice thing to sort of keep dripping in the background to some extent. And I mean, I've talked to, I don't know, dozens, easily, probably hundreds of sellers from cold email that I've booked in over the years.
The biggest takeaway to me of all of that, Matt, is that you've built a personal brand online so that when people Google you, there's a lot for them to learn about you. Because a lot of the other stuff, as successful as your email campaigns have been, the mechanics of that stuff conceptually is well known and done by everybody, sort of thing. But we're still, as much as everybody appreciates that personal brand online is important, still vanishingly few people actually do it, or feel comfortable doing it, or et cetera. And not just like having an Instagram, but like properly kind of crafting an image online so that when you're Googled, some business seller who might be really contemplating selling their business to you, they get a sense of who you are in a real meaningful way.
I was talking to somebody yesterday who was looking to, he was sourcing, he's trying to buy CPA firms. He was working on some sourcing efforts, and I just went to his website, and it was literally like, it was one of those Google prompts that pops up and it's like, this page is dangerous. Like, do you want to advance? Right. And when you advance, it was just like a dead domain that like 404'd out. And I was like, dude, the first thing I did when we were chatting, because he was wanting to connect with some folks in Nashville, and I was like, great, I'm happy to introduce you. And I was like pulling up his website to like send something to some folks, and I was like, well, this doesn't work, right? So it's like, imagine how many leads he's reached out to that go to that website and they're like, this guy's super sketchy, I'm not talking to him.
Yeah.
Right. So he doesn't have to go do podcasts and post on LinkedIn 5 times a week and write articles and newsletters and all this other stuff. Just if you have a nice, clean looking website and your LinkedIn is well structured and you have a good headshot and what you're communicating on there makes sense, you're 85% of the way there in terms of positioning yourself well. But as you said, a lot of people don't do that.
And Matt, one thing we has kind of been talked to death in search land, so smaller deals, acquisition entrepreneurs, is how to present themselves online. And in their copy. Am I an individual, sir or madam, trying to buy your business and continue your legacy, or trying to kind of project more professionalism and seriousness and heft by being like, I'm such and such capital. And so you kind of project that you're private equity, even though you're just, a guy trying to buy a business. How do you think independent sponsors should think about that? And I'll preface that by saying, independent sponsors are private equity, and probably all of them do have a website that is such and such capital. So I guess the question more specifically would be, do you think some independent sponsors could benefit from putting out their brand as a human, individual person, as opposed to such and such capital, which is basically what you've just explained that you do? That's your method.
I definitely think that you can benefit from doing that. And my pitch, quote unquote, to many business owners is exactly that. Hey, and it's true, right? I mean, it's rooted in reality. I'm not some big institutional private equity firm, right? Like if I do a deal with you, it's me. I'm coming to the board meetings. You and me are going to be business partners. We're going to be working on building this business together. And it's not going to be me and 40 people in suits and you'll never see me again. And, all of that stuff. I'm not some big faceless PE firm. I'm a guy who is investing in and buying businesses. And so, and I want to get to know you. And then I talk a lot about this, but I'm a huge believer in over investing in rapport and really building relationships with sellers. And I mean, I've done all kinds of crazy stuff. Like I've gone to the gym and worked out with a seller, and as part of a site visit, like that kind of stuff. I'm just a big fan of really investing in that relationship piece. and also it's interrelated with this, but like understanding what the seller really wants to do. Like, why are they selling? What are they trying to accomplish? Because I say this to people all the time, brokers and sellers, like, we're not the guys who are going to show up to a massive banker auction and be the top bid, right? But we are the people that want to understand you and the business and partner and figure out a way to build this thing and preserve your legacy and take care of your people and all of those elements. And that stems from being a person, not some faceless entity. So I really, not only is that a piece of my positioning, I think that's really the crux of my positioning in a lot of cases.
Matt, let's pivot a little bit because we're starting to bump up on time, but wanted to hit a couple more topics here. What does your organization look like at Holdco level?
Yeah, the Holdco, it's pretty lean. This is why I'm this weird hybrid between a Holdco, maybe a little bit of a self-funded searcher, a little bit of an independent sponsor. And I'm not looking necessarily to be in the business of private equity, if that makes sense. Like in the business of effectively accumulating AUM and earning, fees and promotes on top of that AUM. I really want to be in the business of owning and operating our portfolio companies, right? I want to have a portfolio of awesome businesses that I know and understand well. And if it's a great business, I don't want to sell it. I want to keep it and keep building it. Because I think it's way easier to build a great business you already have more than it is to go try to start from scratch. And so, having said all that, what does my org structure look like? A lot of our infrastructure is in the portcos. We don't have a huge deal sourcing team or any of this stuff. I outsource a lot of it. On the actual team itself, I basically have 3 or 4 people. I've got a full-time director of portfolio operations who kind of helps me, sort of like a PE operating partner, effectively, like helps me manage the portfolio companies, implement strategic initiatives, goes to board meetings, hey, here's the 5 things we need to do. Let's make sure that we help them if they get stuck on this thing, or make sure we introduce them to these 3 people and follow up and get that done. Like that sort of stuff, helping implement KPIs and pay attention to what's going on. I've got effectively kind of a financial guy, basically sort of a overpowered for like bigger than an analyst, but less than a CFO, maybe sort of controllery, analysty type role that we plug into specific portcos, and also helps with deal underwriting, execution, managing data rooms, that sort of stuff. I've got a full-time assistant, but that's like an overseas VA who just handles a lot of admin back-end stuff. I've got a capital markets guy who or cap intro is probably a better term for that. So I do most of the capital raising myself, but he's actually someone I used to work with at Goldman and just knows a ton of high net worth individuals and investors and that sort of stuff. And so he helps make introductions and connect me with folks. And that's the bulk of the team. Maybe at some point it makes sense to get an in-house counsel. We don't have one now, but we have a handful of firms that we really like to work with. All of our financial diligence, we still use, I think pretty much have to use third parties for that stuff, even if you have a huge team. Deal origination, I'm familiar enough that I can sort of tinker with and set up some basic stuff like these drip campaigns and kind of what I would call like a baseline of deal flow. And then I'll just use a specific vendor for specific campaigns, right? So if I want to go do a really aggressive cold email campaign beyond just our sort of baseline drip stuff, I will probably bring in an outside agency. I'm happy to name some names of folks that I like, but I'd probably bring an agency if I'm doing like a direct mail campaign, which we've bought a business out off of direct mail. I would bring in a third party firm to do that particular execution. So it varies a little bit, but it's really a lean team. I'm not trying to build some huge corporate infrastructure. I'm just trying to find a few interesting deals and build them into our holding company.
Since you reverted back to deal flow there at the very end, and how you used agencies to help with new campaigns, I'm curious, what are your thoughts on using AI for deal flow generation? A lot of people ask, how can we use these phenomenal tools to assist ourselves? But, we see quite a bit of automation, as you mentioned, with the mail merge and email plugins. But actually using AI, have you seen any of that? Or what would you say is cutting edge on that front?
So I haven't seen any breakthrough use cases of AI, right? I wouldn't consider it to be AI to just use like an autoresponder or email automation tool, right? That's just basic software. Probably the most common use case that I've seen is using AI for copy. Like what's the email copy say, or what's the follow-up copy? I think that's good, not great. right? I've ChatGPT or others, I think, are reasonably solid at writing copy, but you generally still need to go back and edit it. It's good for sort of rough drafts. I'm a huge believer in follow-up. So most of my email sequences will have I think when I read 10 or 15 years ago, book Ultimate Sales Machine by Chet Holmes. And I think he talks about following up 13 times in that book. And so that stuck with me for some reason. So all my email campaigns have a 13 follow-up sequence. A lot of times I'll have ChatGPT write follow-ups, and they're just like one sentence.
So what's the sequence there of the follow-ups? You said you spread them out over a 4-year period. Is that right?
No, well, so it depends. For a new lead that I'm trying to book a meeting with, it's follow-up over basically on a weekly cadence, and then maybe we'll pace it out to like a monthly cadence on some of the later follow-ups. For an existing relationship that we already have that we're keeping warm, that's a different follow-up sequence. That's every 6 months. We'll just ping them and say, hey, what's up?
Matt, I just wanted to hear on the retail investor side. So your investors, you said, kind of friends, family situation. And what are if you're a long-term hold, what do you tell them in terms of getting them liquidity? Just distributions out of the business?
We'll model a recap or an exit for them in usually year 5 or 7. It depends. We try to align with folks who want to be in it for the long term. And ultimately, if distributions alone can generate a compelling return on capital, that's great. And then any sort of recap or refi would basically be icing on the cake. But we'll typically pencil, hey, we'll figure out whether it's another equity infusion or a debt recap or whatever, a means of or just balance sheet capital, a means of taking them out, year 5, year 7, something to that effect. Okay. And just to pencil some sort of IRR, sometimes you have to model an exit at some point, but we're pretty clear with folks that hey, we orient ourselves towards being long-term holders. And I know we touched on this a little bit, but I fundamentally believe if you want to exit, generally the best strategy is still to have a long-term orientation, because I think you're going to create more enterprise value than if you're cutting corners and taking a short-term view. Sometimes it can work, but sometimes you can set the company up for failure or shrink its ultimate sort of opportunities. I think if you orient towards, hey, we're happy to hold this thing and we're excited about it, it generates more leverage in a sale process, and it gives you a better opportunity to say, hey, we don't need to sell this thing because it's a great business.
Well, Matt, walk us through one of your recent deals. We talked a little bit about it offline, but would love to get some, take the abstract down to the concrete and hear a bit of a case study out of Eidolon Capital.
Absolutely. And I know the deal we talked about is, it's not necessarily illustrative of some of the current approaches we have to doing deals. It was a super creative structure. It was an equipment distribution business, a smaller deal than we look at now. And that's part of the reason we ultimately decided to exit it. But the business was doing about $500K of EBITDA, maybe a little bit less than that, sort of high 4s up to 5. We sourced it via direct mail. So it was a direct mail campaign that, we effectively, I'm sure you've received a letter at some point that's like, hey, Will, I want to buy your house, right? Same thing effectively, but just sending it to business owners and saying, hey, we're interested in potentially buying your business. It was a company that was really old. I mean, it was founded, I think, in the 70s, multi-generation family business. And they had just really underinvested in the business for a very long time. And has just been kind of milking it for whatever cash they could get out of it. And we spent a lot of time building rapport, getting to know them, trying to figure out what they wanted to do, and ultimately presented them with 2 different exit opportunities. One was an all-cash offer that was a lower purchase multiple, and then the other was effectively a highly structured offer that had some down payment, a big piece of seller financing, and also a little bit of effectively a passive equity role. Though it was structured not really similar to sort of a traditional PE equity role. It was more of a kind of a back of a napkin S&B equity role, which I'm happy to unpack the structure of that. But that was the deal structure. It was unique for a bunch of reasons. So one, we ultimately elected to do a share purchase. So the business was a C corp. And the reason we decided to do a share purchase is because they had about $1 million of cash on the balance sheet that they would have had some meaningful tax penalties for distributing, right? And so we basically tacked the $1 million onto the purchase price. And then we went to the banking relationship that they had and we said, hey, this business has $1 million of deposits. We're buying the shares of the company. We'd like a $1 million loan on the business. And it had, $500K of EBITDA. It had some inventory and some receivables and some other stuff as well. We said, we'd like $1 million loan to purchase it, basically. So we ended up getting $1 million loan with $1 million of cash on the balance sheet with the same lender that were the same, bank basically that they had those deposits at. We used that as the down payment for the purchase. And then we effectively seller financed 100% of the purchase from that point forward. So we didn't actually put any equity in. We ended up buying it. I effectively split the equity with the operating partner who was sort of the right hand of the business and was in the business when we did the acquisition. And then, we operated it for a few years, and there's a bunch of reasons why we decided to sell it. One of them was size. One of them was, to some extent, this is a learning about the deal is like, we got it. It was a zero equity structure or whatever. But we paid like a pretty high multiple. So it was, 500 of EBITDA. The pre $1 million of cash purchase price was, I want to say 2.5. So it was a 500K equity roll and 2 million of seller financing. Then we added $1 million. So we bought it for 3.5. So it's like 7 times EBITDA, right? Or on a 500K EBITDA business. So there's like a huge overhang from the seller financing, not from necessarily from a cash standpoint, but just from a enterprise value standpoint that we'd have to sort of build our way out of over time. And there was an opportunity to sell.
And do you reflect on that, Matt, as an error? That you were willing to?
Yeah. So that's part of the
reason. And your logic at the time was simply, if I can buy this business for no equity, I'm willing to pay a premium for it. Essentially,
exactly. That's exactly.
But it's a call option, Matt, right? I mean, you're getting the upside.
Yeah, it was
all of it. But
a call option with the real cost was the opportunity cost, right? Of building in a business that's like really small, very resource constrained from the sense of like you only have so many people in a business of that size. The sector they were selling in had some regulatory challenges. And so, it was just a tiny deal, and it was massively, paying 7x for that business is crazy, right? That business is probably worth 3x realistically, maybe 4.
Right. So it's an extreme example of someone swapping the structure for valuation here. You let go of the valuation because you didn't have to put up any equity.
That's right. And it wasn't a bad deal from a sponsor standpoint, but it was more like the amount of bandwidth that it required was astronomical compared to what we thought it would take of our time at the Eidolon level. And we modeled out, we said, hey, even like a best case scenario, like it's going to take us years and years and years for this thing to be worth the time commitment when we could spend it on a bigger enterprise that grows 10% and creates more value than this business is worth.
Was the seller happy, or did the deferred payment cause consternation on his side too?
They selected the deferred payment structure, right? So they were pretty happy with it. And then when we basically, that part of that rolled, when we sold it to a strategic, they basically loan assumed a lot of that stuff. So they kind of went along for the ride with the strategic that ultimately ended up buying it.
How long did you hold it? And was the meat on the bone there that you thought, even if it was, you kind of underestimated how long it was going to take, how many years it was going to take to make it worth your while? Was it actually the business you thought it was, the opportunity you thought it was?
We held it for 2 years. We sold it to a strategic we got a little bit of a sort of an equity roll piece, but not a huge number over the value because it was so overvalued to begin with, right?
Yeah.
So we were able to grow revenue and build some enterprise value, but the effectively negative multiple expansion on a sale was like erased most of the value that we created.
Yeah.
If that makes sense. So from an opportunity standpoint, opportunity cost, definitely not worth the juice. From a financial standpoint, it was infinite return because there was no equity invested, right? But I learned a lot of lessons about, like, one, how creative of a deal you can do, right? We bought a business for no dollars in with $1 million of cash in it. But we paid 7 times for it, which is too high. And it was such a small business that it wasn't really, it wasn't that exciting to operate, right? It was very challenging, nitty gritty stuff that's like, I want to buy a business where I can bring in super big guns, like high powered people. And if you have a couple $1 million of EBITDA, it's a lot easier to do that. And you don't need to move the needle nearly as much. Like 20% growth on a $4 million EBITDA business is almost 2x the EBITDA of this company. You know what I mean?
Right.
So it was an interesting deal. But I learned a lot of lessons about size, opportunity cost, structure, etc.
How do we learn these lessons before we learn them? If that makes sense. Like
I wish I knew.
Instead of learning by doing, how do you when you're 30,
You
35, 40?
More podcasts.
Yeah, thank you. Took the words right out of my mouth. And Matt, Eidolon today, what is aggregate EBITDA? Can you share that?
Yeah, I would say roughly, I was trying to do this math earlier because I thought you were going to ask me this question. I'd say it's probably like low sevens, something like that. Back of a napkin. And we're working on, we're under LOI on a deal that would potentially push us to 8 figures, but knock on wood, haven't closed on that one. But it's probably like low to mid sevens right now in aggregate.
Well, Matt, you're a natural communicator, so it's been a lot of fun to listen to you. We could have gone on much longer, so that probably means we'll be knocking on your door to come back at some point. But in the meantime, how can listeners reach out to you? What do you prefer? You're as we've made clear, you're very Googleable and findable everywhere. But is there a preferred way that people reach out?
The easiest way is just I have a newsletter. It's free. It's at my website, mattbodnar.com. I talk about M&A and deals and sharing some of the lessons learned, as Nicholas said, about good, bad, ugly deals I've worked on, methods that have worked for me, things that I find interesting in the M&A world. And that's probably, and I respond to really anybody who hits reply on that. Is just me personally answering them back. So that's probably the easiest way to get a hold of me.
Perfect. Matt Bodnar, Eidolon Capital, thank you very much for coming on Meeting of the Minds, sir.
Thank you so much for having me. It was a great conversation and really enjoyed chatting with you guys.
Hope you enjoyed that interview. For more like it, subscribe to Meeting of the Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.